Hi guys, this is Mansfield from Mac Partners. Thank you for returning to our channel. 2 weeks ago when we issued the part 1, we highlight about the importance of capital outflow, which dominates our valuations. And therefore, any stock market rebound is going to be short-lived. And for the past 2 weeks, Hang Seng Index actually edged lower. So in the part 2 of this series, we try to identify the condition for a pause in the capital outflow. Let's talk about some key points first. The Fed governors worry less about overshoot in rates. For the past 5 US rate hike cycles, they all ended with positive real policy rates. We identify 3 signals of a market bottom. Firstly, if there is any sign of systemic risk, or China start its fiscal stimulus program. Finally, an early resolution of Russia-Ukraine conflict. Market will only bottom when outflow pause, and this is mainly controlled by the US Fed. So they may stop if they see sign of inflation under control, or they worry about a hard landing in this economy. Another investment myth that we want to talk about, most people believe that raising interest rate is a appropriate tool to control inflation. But we don't think so. Inflation means the demand is larger than the supply. So the best solution is to increase the supply or suppress the demand. So therefore, raising interest rate cannot resolve the supply destruction issue. Let's look at the inflation issue now. We think this is a man-made supply destruction because of these trade sanctions on the China by the US, deglobalization, and also the energy sanction on Russia. So lifting the energy sanction will be the more effective way. However, US decided to raise rates to suppress demand as the path. So in terms of raising rates, there are 2 choices, a faster pace or a slower pace. A slower pace means it will take more time to arrest inflation, and also means that the high level of interest rate is going to last longer. A faster pace may result in recession. During the recession, stock market will come down due to the earnings downgrades. Let's look at the past interest rate hike cycle. As you can see here, the current rate hike cycle is the fastest, 300 basis points in 7 months. But we think this is still not enough. To understand why this is not enough, we need to take into the concept of real interest rate. Mathematically speaking, real interest rate equals to nominal interest rate minus inflation rate. And nominal interest rate are the lending rate or the saving rate offered by the banks. So it doesn't consider the impact of inflation. So for real interest rate, they will understand about your purchasing power. Say for example, if the inflation rate is lower than the saving rate, this is positive real interest rate and people will save more. When the borrowing rate is much lower than inflation rate, that gives a situation of negative real interest rate, and investor will try to spend more or borrow more. So let's take a look at the past 5 US rate hike period, and you need to pay attention on the real Fed fund rate. So what you can see here is that for the past 5 cycles, the Fed will only stop when the real Fed fund rate all turn positive. The situation now is that we are still at highly negative real interest rate. Say for example, in March, when we start raising rates, the real Fed fund rate is minus 8%. Now is minus 4.9%. That means it is highly stimulative. In order to bring it down to a positive real interest rate, we need to have more rate hike, and also a lower CPI. And this is not only happening in the US. When you look at the world, US, apart from US, Europe, Japan, UK, they are all at negative real rates. So the environment is very stimulative, and therefore there will be more rate hikes to go around the world. So what is the Fed's viewpoint now? We believe they worry more about the risk of ending tightening too early. These can be supported by the September FOMC minutes only received on the 13th of October. There are two main quotes here, which we got from the FOMC minutes. They worry about the cost of taking too little action now, and also from the past experience, they worry about a danger of prematurely ending the tightening. So what will be the impact on the financial assets? If they choose to have a slower pace in interest rate hike, then the borrowing cost will rise slowly, and it will suppress the spending of consumer and slow down the capex of the corporate. This will gradually bring down the demand, and therefore the impact on the financial asset will not be significant. However, if they choose a faster pace, then that may lead to liquidity tightening or liquidity crunch, and we will bring to investor for fear of recession, and asset prices will collapse. Demand will collapse also. It will take shorter time, and it is what we call the negative wealth effect to bring down inflation. So what are the takeaways? The Fed governors are worry less about overshoot in rates, because the first priority is controlling inflation. And from the past 5 US rate hike cycles, they are all ended with positive real policy rates. Given that we are now still at high negative real policy rates, so there will be more rate hikes to go, and don't expect the Fed will stop early. We identified 3 signals of a pause in the capital outflow. These are all, firstly, if there is any sign of systemic risk, the Fed may stop the cycle early. For example, the liquidity crunch in the UK gilt market in October, it actually pushed the BOE to do QE. Or if China starts this fiscal stimulus program, then probably there will be more inflow back to the risk assets. Lastly, an early resolution of the Russian and Ukraine conflict, that will also be positive, as people are less worried about inflation, and very likely the rate hike cycle actually pause here. This is the end of today's video. Thank you for your attention. If you like our video, please give us a like, share with your friends, and don't forget to push the subscribe button so that you are not going to miss out any videos in the future.